Nvidia and AMD are both down more than 50% since November 2021. That's a 50% drop in just over 6 months. In the next 5 minutes, I'm gonna tell you exactly where I think the valuation is and if I think they're good buys moving forward. Okay, if you watch this channel, you know I believe in transparency. This is the portfolio. I'm building $10K to $1 million right here on the channel. Like the video and subscribe if you wanna see that. But most importantly, for this video, I wanna show you that I do not own either of these stocks. Here are the stocks I own. I go into full updates on Fridays on this channel if you want to see that content. I'm using fast graphs. I'll do a quick explainer. This black line is the current stock price. This blue line, when you see it on the screen, is the average. Right now we're looking at PE ratio, price to earnings ratio. That's the average price to earnings ratio over the time period we're looking at. So we're looking at the time period since 2002. The orange line is the price to earnings growth ratio. So that's their earnings growth has been 21% on average over this time. So that would be a PE of 21 if the price to earnings growth was 1. So you can see that Nvidia, just to start, you can see in November of 2021 how absolutely insanely ridiculous this stock got. It had literally almost never traded at a PE of 81. I mean, maybe it never had before, and not even back in the 2000s did it ever trade at a PE of 81. So clearly things got out of control. That's lesson number one. Just because a stock traded at 329 and a PE of 81 doesn't mean it's going to go back there anytime soon. So we should not assume it's going back to all-time highs. I don't think it's going to go back to all-time highs for years, potentially more. But that doesn't mean it's not a good investment right now. What the right side of this chart shows is what analyst expectations for earnings growth over the next 3 years are. So for the next 3 years, analysts are expecting 23% earnings growth, 16% earnings growth, and 21% earnings growth. So if we look at it, that's about in line with what earnings growth has been over the last 20 years. So what I want to do is I want to figure out what a realistic price to earnings ratio to expect for Nvidia would be. And we can use this blue line, except that there are these extremes. And right now, this extreme from 2021 is factored into the average. So I want to take that extreme out. Okay, this is a little crazy and it's a short period of time. We're only looking at 2011 to 2017. But it's 6 years, and I think that the price to earnings was reasonable. There was a couple times where it was undervalued or under its average, and a little bit where it was over. So I think that gives us a general idea of what a good normalized PE ratio could be. So let's say 24 is a decent normalized price to earnings ratio with earnings growth of 25%. If going forward the earnings growth is less than 25 or 26%, then I would expect the PE ratio to be less than 23. That's kind of how I think that relationship should work. It could be right, could be wrong, but that's how I think about it. So if we go to forecasting, we can see that the expected earnings growth rate over the next 3 years is 20%. That's less than that baseline. So I would expect the price to earnings ratio to be 24 or under. So that's how I can start to think about where is a range of prices for this stock. And so if we go out to 19 in 2025, you're looking at a total return of 1%. I'm okay with that with kind of the low end. If we go up to 25, which I think would be the absolute high end of where this thing should rationally trade, it could get way over that, but I think that would be a little bit unrational. Then you're looking at a price to earnings ratio of 26, you're looking at an 11% annualized rate of return. So that's a total return of 31% over the next 4 years. Okay, so if we say 26 is the high end, 20 is the low end, let's go right in the middle and find 22, and that's kind of our baseline. So we're looking at a 11% baseline potential return through 2025 for 4% annualized. What could change that? Well, if the company beats these expectations, then the price could be a lot higher. If they miss the expectations, then the price could be a lot lower. So what is more realistic to happen? If we look down here at how the earnings estimate trends have changed, you can see 6 months ago for 2023, analysts were expecting 515. Then they were expecting 565. Now they're expecting 546, so that came down a little bit. This reflects the sense of macroeconomic pressure that companies are feeling. I think this is a decent expectation, and if anything, I think it would go down a little bit than up, just given the macro scenario. I wouldn't expect a price range of over this PE of 26, because if anything, I think the estimates might come down a little bit. So I would be more comfortable baselining to around this PE of 22, which would be a share price of 167 out to 2025. So that's Nvidia. AMD, I've talked about this on this channel before, is actually really hard to go back and get a baseline because of how inconsistent their earnings have been as they're going through different phases as a company. So I'm going to compare it because it's a similar comparison to Nvidia, actually. And so if we think that these numbers are reasonable, a price to earnings ratio of 21 or 22 on 20% earnings growth going forward for Nvidia, I'm going to use that same baseline going forward for AMD. And so here you go. Analysts are expecting basically the same earnings growth. And so this is where it goes into like, what do these analysts really do? It's like, do they just come up with these numbers and then match the companies that are similar to it? And that way their job is safe and they don't miss real bad or something. So sometimes analysts' expectations need to be taken with a grain of salt. That's something to remember as well. But just going with what we have, a 19% earnings growth rate. If we do the same thing, again, kind of baseline out to 2025 at a PE of 19, the return scenario is so much better for AMD at a 45% annualized return, total return versus a 16% annualized. Much stronger return picture for AMD than Nvidia at a PE of 20 in 2024. And so what investors have to decide is which scenario they think is more likely. Which is the better company? Is AMD the better company? Do they have a more reliable revenue stream? Or is Nvidia the better company? And do they have a better picture and more reliable revenue stream? Let's jump over to Morningstar and see what Morningstar thinks. So Nvidia is a 4-star price according to them. They say it's trading at a 24% discount to fair value. They think it has a wide economic moat, an exemplary capital allocation. A 1-star price, meaning they think it's overvalued, would be 310. Up from 151, that's a double. A 5-star price where it's very undervalued would be 120, which is only 20% lower from here. So that's Nvidia. AMD gets a little bit of a better rating, a 5-star rating, and they think it's a 42% discount to fair value. So kind of what that scenario in that range of expectations points out in the graph and based on historical earnings and future earnings. Morningstar is kind of thinking along those same lines where they think AMD is trading at a much larger discount. They have the fair value at 130. The last close was 75. A 1-star price is 201, which is more than a double, so more upside to that 1-star price than Nvidia. A 5-star price is 78, which is why it's 5-star, because it's lower than that. Economic moat is narrow. Capital allocation is exemplary. And that's the difference. So they think Nvidia has a wide economic moat, which could be a big deal. That means they have more competitive advantages, harder to disrupt. That's because a lot of what Nvidia is doing in the software and in data centers, they just think they have a stronger position. Whereas AMD, they think is more kind of commoditized and easier to disrupt. Maybe they think there's more competition.